Colin, do you think QE needs to be increased to offset the amount of supply we're going to get from the Treasury?
Hi, Jonathan. At this time, I don't think it needs to, but I think the more important point is that if it has to, it'll take place. I think with respect to quantitative easing, I certainly take Chairman Powell and the Fed at their word that they will do whatever it takes, and that includes not only just the quantitative easing that helps support the market functioning, but any type of quantitative easing that would have to take place to, for example, control where rates are, possibly control the yield curve, and both easing more and easing less, also trying to protect the market against rates going negative in any way, shape, or form.
Colin, we'll talk about negative rates in just a moment. Let's talk about the Treasury market. We've seen this play out in Japan, where the BOJ owns a huge chunk of the market, and the BOJ has also set a price, 0, and yields don't go over that. They just sit on top of it, and if they start to go over that, they start to buy. Some of those bonds hardly trade. They can go for days without trading, and I think for a long time people have looked at Japan and said, that's just Japan, it'll never happen here. Is that where this is heading in the United States? And if I'd asked that question a couple of years ago, I think there still would have been a lot of people that would have written to me on Bloomberg. The IBs would have lit up and said, you're an idiot, that's not going to happen. But it just feels like people take that a little bit more seriously now, Colin, that this is where things are heading. Do you think they are?
Actually, Jonathan, I do. Also, I clearly wouldn't have been one that would send you a note that said you're an idiot. That wouldn't have come from me.
Well, you've always been kind to me, Colin. I know.
But that's right. But in full disclosure, I want to be fair about it and say that if it was a couple of years ago, I certainly wouldn't have had the attitude I have now. So I'm much more open to it being a possibility. The probability of it happening to me has risen dramatically in the last couple of years. So a couple of years ago, I would have said next to 0. Now, if I said anything less than a 25% chance, I think I would be fooling myself.
So where does this leave us with the negative rate debate? Because most people dismiss that still in the United States. I, for one, want to believe the Fed won't do it. I listen to the Fed. They say they won't do it. Yet still, people think they might do it. And there are reasons for that, because we hear central banks in the past say they won't do it, then they will. The Bank of England have said they wouldn't do it, and now we've had 2 policymakers in the last week flirting with doing negative rates. Colin, do you expect them to even signal they'd make a move towards negative rates in the United States anytime soon?
Okay, I'll take a really strong stance on that, Jonathan, and my answer is unequivocally they will not do that. I think that would be a last resort. I do trust their judgment that their thought process around negative rates elsewhere, whether or not they've been effective, the jury's still out. So I'm willing to really put the gauntlet down and be one of those that would say, absolutely not. We may have other issues with respect to the yield curve, but it will not be the Fed taking rates negative on purpose.
I hope you're right. Well, let's talk about what it all means for credit. Just a final question to you, Colin. You have been long and right on the Treasury market for quite a long time. You called for low rates, much lower rates than many people anticipated. We got there. Let's talk about credit now, because you started to think about taking a little bit of risk at the back end of 2019. And I'm sure it's been difficult through 2020. So, Colin, how has your thinking evolved?
Sure. And you're absolutely right that, in late 2019 when I was with you, definitely positive on the credit side, positive on high yield. It's been a rough ride. I think that there's a lot of attractiveness in the credit market right now, and a lot of it is helped out by, obviously, the Fed support. The Fed support many parts of the market is very helpful. So if I had to look at going ahead and putting money in the market at this point, it's hard to argue when we're testing sort of the comeback that we had with respect to high yield spreads when they ballooned out to 1100 as an OAS, and they got back to close to 700, and then we've had some sell-off again. Well, they're getting back towards 700 again, and I think overall the demand for fixed income is very strong. Interest rates are going to stay low, 0, for a long, long time. Jonathan, I wouldn't even forecast that the Fed raises rates until 2025 at the earliest. And so if I put that into my calculus, Fed support for the market, no interest rate hike for at least 5 years, high yield with an OAS of 700 plus, it's hard not to see that as attractive.